Welcome to a tutorial on the weighted average cost of capital, or WACC.
Weighted average cost of capital is the required rate of return used by the firm to evaluate new investments. It includes both the after-tax cost of debt and the cost of equity. These are then weighted by the relative percentage of debt and equity in the capital structure. Let's look at each component. Capital is the sum of the market value of debt and the market value of equity. The debt-to-capital ratio is the market value of debt divided by the firm's capital. It is the percent debt. The equity-to-capital ratio is the market value of equity divided by the firm's capital. It is the percent of equity. T is the marginal tax rate for the firm. K sub D is the required rate of return to debt holders. Note that K sub D times 1 minus the tax rate is the after-tax cost of debt to the firm. KE is the required rate of return to equity holders. Let's examine each of these in more detail. Debt is measured as the market value of debt and not the book value. Debt also includes both short-term and long-term debt. Very often the difference between long-term and short-term debt is that long-term debt is fixed-rate debt and short-term debt is variable-rate debt. We should include both to the extent that they are both part of the permanent capital structure of the firm. Finding the market value of debt can be quite challenging. It is easier if at least some of the firm's outstanding debt is actively traded. We can then use these prices to determine what is the relationship between market value and book value. However, since current bond prices are usually not available, we very often assume that the market value of debt is equal to the book value of debt. Equity is measured as the market value of equity. We can calculate the current market value of equity by taking the current share price times the number of shares outstanding. Capital is just the sum of the market value of debt plus the market value of equity. The weight that debt has in the capital structure is the ratio of debt to capital. K sub D is the required rate of return to bondholders for bonds issued today. It is not what the firm is currently paying on outstanding debt. That interest rate could be what the firm is paying on debt issued a long time ago. We want the current required rate of return of debt. The big question is, how do we estimate it? There are two approaches. If there are prices available on a firm's bonds, then we can use these prices to estimate the yield to maturity on these bonds, and we can use this as our estimate of the bondholder's required rate of return. Let's look at a simple example. Suppose that ABC Company has two outstanding bonds which are actively traded. Bond A has a coupon rate of 8% and 10 years left to maturity. It is currently trading at a price of $982 per $1,000 of face value. Bond B has a coupon rate of 6% and 7 years left to maturity. Its current price is $883 per $1,000 of face value. Based on this information, the yield to maturity of Bond A is 8.27% and the yield to maturity of Bond B is 8.23%. Please see the technical note on bond pricing and the yield to maturity for a discussion of how to find the yield to maturity. Also, there is a link on this page that will take you to a spreadsheet where YTM is calculated. Based on this information, a reasonable estimate of K sub D, or the required rate of return to debt, is 8.25%. A second approach is to look at required rates of return for bonds issued by comparable companies. We define comparable as bonds with the same bond ratings. The two major bond rating agencies are Moody's and Standard & Poor's. This table shows the bond ratings used by each agency. The highest quality bonds have ratings of AAA by Moody's and AAA by Standard & Poor's. The lowest rated investment grade bonds are BAA with Moody's or BBB with Standard & Poor's. Bond ratings below this are considered to be of speculative grade. Bond yields for different bond ratings and maturities are readily available through the financial press. Public sources such as CNN Financial, The Wall Street Journal, Barron's, or YahooFinance.com are all good sources. The next slide shows the yields for different maturities for Standard & Poor's bond ratings. If your company's bonds are rated A1 by Moody's or equivalently A by Standard & Poor's, then for a 20-year maturity, you would expect a required rate of return of bondholders of 6.24%. Now let's look at the required rate of return to equity. K sub E is the required rate of return to equity. For a full discussion on how to estimate K sub E, please see the technical note on the cost of equity. Here we will use the CAPM, or the capital asset pricing model, to estimate K sub E. We want a risk-free rate that matches the maturity of the investment. Usually this is a long-term rate, 10 or 20 years. The market risk premium we will use is 5%. Beta is based on using either historic data or a proprietary source for an estimate of beta. In some cases, a firm is not publicly traded and neither historic data nor proprietary source is available. In this case, we will use beta estimates for comparable firms. Now that we have examined each piece, let's put it together with an example. For this example, we'll estimate the weighted average cost of capital for Target. We start with the financial data for Target. This is the income statement for Target for the fiscal year ending January 2007 and January 2006. The most important pieces of information here are the current stock price, number of shares outstanding, and the beta estimate. Next, we'll need the balance sheet. Here is the balance sheet. We need this to estimate the capital structure of Target. Focus is on debt. We will need the market value of debt, but in this case, we will make the simple assumption that market value is equal to book value. Let's get started. Now we'll estimate the weighted average cost of capital for Target. The starting point is to estimate the capital structure. First thing we need is the market value of debt. We assume that the market value is equal to book value and use the book values of short-term debt and long-term debt as our estimate of the market value. We take these directly from the balance sheet. The market value of debt is estimated at $10.037 billion. The market value of equity is equal to the current stock price times the number of shares outstanding. The decision to use basic shares or fully diluted shares is a matter of judgment. Here we have chosen to use fully diluted shares. In this case, most of the data was available on the sheet with the income statement. With a stock price of $62.27 and shares outstanding of 868.6 million shares, the estimate of the market value of equity is $54.088 billion. Target's total capital is the market value of debt, $10 billion, plus the market value of equity, $54 billion, for a total capital of $64.125 billion. This translates into 15.7% debt and 84.3% equity. The marginal tax rate for Target is estimated from the income statement. Using the most current income statement, the tax rate for January 2007 was 38%. Let's assume that Target's bonds are rated A. As such, using a 20-year rate, the estimate of K sub D, or the required rate of return to debt, would be 6.24%. K sub E is estimated using the capital asset pricing model, or CAPM. Here the inputs are: the risk-free rate is the yield on the 20-year Treasury bond, which is 4.81%. The beta, using 5 years of historic data, is 1.36, and the market risk premium is what we had estimated before at 5%. Taken together, this yields an estimate of the cost of equity for Target of 11.61%. We can now estimate the weighted average cost of capital for Target. WACC is equal to the required rate of return on debt of 6.24% times 1 minus the tax rate of 38% and is weighted by the debt in the capital structure of 15.7%. The required rate of return to equity is estimated at 11.61% and its weight is 84.3%. This yields an estimated weighted average cost of capital of 10.39% for Target. This is the rate the Target should use to evaluate new investment alternatives. Key concepts concerning WACC are: 1. WACC is the hurdle rate necessary to satisfy both debt and equity holders. 2. Everything in WACC is in terms of current values, not historic values. And finally, 3. WACC is a market-determined required rate of return, not a managerial determined rate of return.